Well, it's time for the business news now with Charles Pellegrin, who joins me in the studio. Good to see you, Charles.
Hi, Inka.
So we're starting with a story that's putting two rather nostalgic names of the early 2000s back in the spotlight.
We're talking about gaming retail chain GameStop and online marketplace eBay. They're making headlines this Monday after GameStop made an offer to take over eBay for $56 billion in both stock and cash. This equates to $125 per share, so about a 20% premium on what eBay stock is currently worth. GameStop already actually has a 5% stake in the bidding site, and it plans to finance this deal thanks to $20 billion in debt financing, and then promised to find $2 billion in annual savings within a year of that deal closing. The move is notable because eBay is considerably larger than GameStop. Current market capitalization shows eBay is 4 times bigger than its counterpart, worth over $42 billion versus the gaming company's $11.9 billion. This and the fact that eBay has been successfully navigating a turnaround and it's on its own, its shares up 50% over the past year, has led to skepticism on the part of investors and analysts as to the actual feasibility of this deal.
So, Charles, why is GameStop so eager to pursue this deal then?
Well, in recent years, we've started seeing an overlap between these two businesses with a focus on collectibles like trading cards or sports memorabilia. GameStop sells them in its physical stores while users put these objects up for auction on eBay. So there are potential avenues for synergies there, and GameStop would tap into eBay's 135 million active buyers. This could allow GameStop to grow into a much larger e-commerce website, which could potentially rival behemoths like Amazon. At least that's the ambition of GameStop's CEO, Ryan Cohen. And he's a big part of this story, too, saying in an interview that he believes, quote, eBay should be worth and will be worth a lot more money, and adding that he's thinking about turning eBay into something worth hundreds of billions of dollars. And he has a lot to gain if he pulls this takeover off. His compensation package means he could make as much as $35 billion if some goals are met, including if he turns GameStop into a $100 billion company. This would be a remarkable end for a company that was widely seen as a nostalgic joke just a few years ago, but then ended up becoming the star of the meme stock movement of retail investors during the pandemic.
Well, Charles, let's check in now on the markets this Monday.
In Asia this Monday, we saw South Korean stocks hitting a fresh record boosted by tech giants Samsung Electronics and SK Hynix, buoyed by positive sentiment following U.S. tech earnings. In Europe this Monday, we're seeing a mixed open. U.S. President Donald Trump threatening to increase auto tariffs on EU cars up to 25%. So we're seeing German car makers' shares fall at the open. As you can see, the DAX slightly higher, though. As for oil prices, they are ticking upwards at the moment, but as always, volatile as investors assess plans to reopen shipping in the Strait of Hormuz, with Donald Trump saying the U.S. would attempt to free stranded ships affected by a closure of the strait in a Truth Social post on Sunday.
Next now is shock to the U.S. airline industry as one of its low-cost mainstays collapsed over the weekend.
Spirit Airways had been in business for nearly 35 years. On Saturday, it abruptly ceased operations, leaving passengers scrambling to get to their destinations and crews far from home. The company had been in trouble for years, but the skyrocketing price of jet fuel due to the war in Iran proved to be the final straw. Brian Quinn has the details.
A hard landing for Spirit Airlines. This weekend brought surprise and dismay for its passengers and staff as the low-cost carrier abruptly shut down Saturday, leaving not just travelers but also crews stranded around the U.S. and Latin America.
It's going to be a very difficult challenge now for the passengers and the aviation industry. For me, it's a big hit. It's a big hit.
By Sunday, Spirit said it had nearly finished refunding passengers and getting crews home, with other U.S. budget carriers like Frontier, JetBlue, and Southwest offering discounts to help travelers reach their destinations. After 34 years of operations, Spirit had been struggling recently, twice filing for bankruptcy after a planned 2024 merger with JetBlue was blocked by a federal court over antitrust concerns. Its most recent crisis, though, came as the U.S. and Israel's war on Iran has sent jet fuel prices soaring to nearly double their pre-war levels. A proposed $500 million bailout from the Trump administration fell through at the last minute, reportedly rejected by the company's creditors, as the government would have effectively taken ownership of some 90% of the airline.
From the government's perspective, we oftentimes don't have $500 million laying around in a spare account that we can put into a bailout of an airline. So there was creative thinking on how it could happen.
Spirit's collapse has led to fears for the viability of the U.S. low-cost airline model. Rival JetBlue is more than $8 billion in debt and hasn't turned a profit since the COVID pandemic. Meanwhile, at traditional legacy carriers, recent years have seen the majority of profits driven by high-end passengers and premium upgrades.
Charles, thank you so much for that. Chapeau grand there. With the latest in the world of business, it's time now